Good morning, everyone, and welcome to the Macro Snapshot. We are Friday, September the 5th. Is it? Yeah, September the 5th, 2025, recording this in the morning. Okay, so let's have a good look at the payrolls. This will be mainly sort of a payrolls preview, but just wanted to check. We had a Broadcom last night after the bell, or yesterday afternoon, and as you can see in the pre-market, trading up from close to 305, 306 up to 339. So pretty positive outlook for the semiconductor manufacturer Broadcom. So that in theory is going to give a positive sort of tone to Nasdaq today, and the other stock indices. But of course, a lot will be determined by the non-farm payrolls. But I thought we'd just have a quick look at that. Other thing as well, just to keep an eye on here, just wanted before we look at some other stuff, is just to look at the USD CAD. Because we also have Canadian data this morning. We have Canadian payrolls at the same time as US payrolls. So interesting just to see here that the USD CAD, is essentially trading in a range between, let's call it about 139 and 137 and a half or so. So that could be determined today that its next direction by a combination of the US and the Canadian data. Okay, so let's just look at the non-farm payroll situation. First of all, as I always like to do, I like to start off with recent employment data just to get a sense of where the market is at. So as you can see here, the ISM sort of manufacturing, the employment number was actually pretty weak there. So 43.8. So that is definitely sort of in contraction territory. And that's about, 20-30% of the US economy. So ISM employment for manufacturing was weak. Then we got the JOLTS number, which overall was which was weak as well. We had less job openings. We had people not quitting as much. So that should be putting downward pressure on wages because people are not as confident to quit. And then, of course, the layoff rate actually went up. So it had been at 1.6 million. It did rise to 1.8. So the layoffs is also going up a little bit. So overall, I think we can say the job openings and labor turnover survey, the JOLTS was pretty weak as well. So at this point, we're getting a sense of weakening labor market. If you look at the challenger job cuts, they were also up quite a lot. They were quite bad as well. So more job cuts than expected. And then the private survey ADP. Came in at 54,000. So that's half of what we got last time, which is 104,000. So that was also a little bit weaker. If you look at initial jobless claims and continuing claims, you can also see that initial jobless claims, it's better not to look on a week-by-week basis, probably like a 4-week moving average. But on the last number, which we got yesterday, was up to 237,000, which is starting to creep up a little bit. And if we look at the moving averages, the 4-week moving average also up to 231 compared to 228. So the moving average also going up. And then continuing claims remaining, relatively elevated. So overall, I would say that it does seem that at least in this recent data that the job market, the labor market is weakening a little bit. It's not as though people are being fired, in massive amounts of numbers, but companies are definitely not sort of accelerating their hiring and their employment. People are getting a bit nervous. If you look at some of the surveys, like some of the conference board consumer confidence surveys, people are saying that it's harder to get a job. So definitely there's a little bit of pessimism. Companies are being a little bit more careful, and the actual hard numbers are also slightly deteriorating. Not in a massive sense, but what tends to happen historically in the labor market is that things start to deteriorate because companies don't like to fire people immediately at the first sign of softness. But then once, the general economy goes, people do start to get fired. Then there's the snowball effect as fired people don't spend money and therefore company earnings go down, and it can move fairly fast. So that is not great. Okay, so in terms of what the market is expecting today, I just want to look at the Fed in terms of the Fed, what the market is expecting for the Fed, just the broader sort of context here. No, actually, we'll look at that in a second. Let's go straight into the data. So we can see what's expected here is a 75,000. So again, really what we have to be looking out for is that number. We also, not even so much the hourly earnings at this point. It'd be great as an extra bonus to the Fed if they were contained to 0.3 or maybe 0.2, something like that. But the thing is at the moment is that the market does think that the Fed will cut almost no matter what. And the idea is that, if the labor market were to weaken, that in the natural course of things would dampen sort of price pressures in terms of wages. So that's probably not the most important number. What is going to be very important is the unemployment rate, expected to tick up 4.2 to 4.3. And Powell himself has said that excuse me, rather than even the headline number, that is the number which he's almost, the most important number. So that's definitely going to be a very important number along with the headline number. Now, in terms of the headline number as well, what's going to be very interesting is that we all know that Powell fired. You'll remember that the revisions last time, we got 258,000 for the 2-month net revision. So this number is also going to be extremely important. The market really, really wants to know if the recent month or two is going to be revised upwards or downwards. And also, one could argue that because Powell didn't like this number and said it was all nonsense and that the BLS, Bureau of Labor Statistics, had become completely politicized and was incompetent, we all know that Powell fired that person and now there's a new person in charge of the BLS. So these numbers, I mean, do we take them with a grain of salt? Are they going to be heavily politicized? Does the market believe that the numbers are heavily politicized? So let's say, for example, we get a very positive number, so not 75,000, but I don't know, 100,000, 120,000. Will the market's reaction be less sort of hawkish in a sense and say, well, hey, these numbers have probably been massaged? It's interesting. It's an interesting one. So I think it's a little bit asymmetric in the sense that a very high number, I think, will be met by, at the minimum, a raised eyebrow or a little bit of skepticism by the market. Is this the beginnings of political influence? On the other hand, a lower than expected number, a soft number, will sort of start to confirm. Sorry, just got some fire engines outside. Hope that you can't hear that. Quite noisy. Will a softer number be taken really as a confirmation of the weak data and the necessity for the Fed to cut not only twice this year, but 3 times? So I think it's a little bit asymmetric. But just in terms of the pure numbers, let's just look at the what the market is expecting here. So if we look at the economist estimates, this is for the headline number. You can see that the median or the mean is about 75,000 here for the average. High estimate and the low is between the 0 and 144,000. So there is quite a lot of dispersion there. And normally when there's quite a lot of dispersion, that also means that there's a lot of uncertainty. So don't be surprised if we get something which is outside the standard deviations. You look here, the standard deviations here, you see that 75,000 is the mean. Then you look at one standard deviation, be down about 55,000. On that top side, on a beat, a standard deviation be at about 95,000. So keep in mind that a standard deviation is about 20,000 in terms of the Bloomberg consensus here. So anything which is one, especially two standard deviations, is really going to get the market's attention. So keep in mind that we've got 20 or 40,000. So 40,000 would be less, would be, let's say, 35,000, which would be taken as a very, very soft number. Of course, on the upside, anything above what would 40 and 75 be? That would be 115, and sort of up here or so would be two standard deviations. That would be a massively higher than expected number. But as I said, I think that would be greeted with a little bit of skepticism. So that's that. Let's keep an eye on that. Now, in terms of what the market is pricing in, as you can see here for September, it's a 97% chance of a cut has been priced in by the market in terms of the Fed. So this is the upcoming meeting, which of course is 24 basis points. If we go to the end of the year, we can see that we're up to about 2.3 cuts, so 58 basis points. So actually over 2 cuts at this point. So the market has definitely in the last few sort of week or two leaned in dovishly, and is expecting quite a weak number here. So I think if we do get a weak number, as I say, 30, 40, 50, 60,000, that will be really cementing September and possibly even like an October cut as well. And we could see that these numbers in October and December, that sort of reprices in quite a dovish way. Obviously, what would that mean in terms of the markets? A soft number would be bad for the US dollar. It would be great for the front end of the curve. So we'll see sort of a front end led bull steepen here. So we'll see the 2-year going up a lot by comparison with the 30-year, which is not to say the 30-year can't go up, but there's always going to be the concern that if, for example, inflation remains sticky, if the wages remain sticky, that the market may be concerned that the Fed, the new politicized Fed, is less focused on inflation, and so therefore that's not great for the long end of the curve. On the other hand, what we could see is that if the numbers are very, very weak, it's going to be interesting, this question of inflation, because if the numbers are very, very weak, that could indicate that obviously the labor market is softening, but also the real economy is not too far away from perhaps deteriorating a little bit. And that would imply also that general economic activity could go down, which would be a depressant for inflation, which in turn would be not bad for the long end of the curve. So my point here is that although a soft number, one could argue, oh, the Fed's going to cut interest rates and stimulate the economy and not worry about inflation, and therefore that's bad, and that's a steepener in terms of the long end yields going up. There's also that sort of counterbalanced weight that, at a certain point, if the economy really does start to deteriorate and the labor market really starts to deteriorate, that will depress economic activity, which should push down the 30-year yield. So if we actually just have a quick look here at the 30-year yield, my point being that there will become a moment where the 30-year yields, which are now at here we are, just bring that up, which are now down to 4.85. They've come down quite a lot. They could actually come in a little bit more. And so it's not my viewpoint necessarily that these yields are going to rise too much more, assuming the numbers are weak. If the numbers are strong and inflation remains sticky and the Fed does indeed become very, very politicized and cuts into a strengthening labor force and a strengthening economy, that's a different situation. I'm not saying that. I'm saying if the economy is weak, if the labor market is weak. So the point is here, let's keep an eye on the 30-year yield itself. That's going to be quite interesting. And if we look at the yield curve, if we go to the 230s here, you can see that it has steepened a lot over the last few months. It's flattened out a little bit in the last couple of days here. You see, just taking a little bit of a pause. So I think it's going to be an interesting one here. I think a very, very cold number, we actually could get like a relatively flat yield curve. It may steepen in the short term, just on the excitement of the front end yields going down. But overall, there will be some nerves from the market just in terms of whether the real economy is actually sort of flattening out a little bit. So that's something definitely to be interested in. Of course, if we get a soft number, no doubt gold can resume its rise. I mean, it's come a long way, just taking a pause for a couple of days. But if, a soft number, probably should be a positive for gold. For US dollar, no doubt that will weaken on a soft number. Let's have a quick look here. And with it, the euro will go up. So we see here, the dollar index here has been in just a sideways range. So maybe this is the moment today for some kind of a boost up or down. Similar thing here for the euro. Let's just bring up the euro USD here. You see that's also been in a trade range. Again, today's numbers will no doubt sort of push that up above the range or down below the range here. Keep in mind that on Monday we do have in France we have the confidence vote in the French Parliament. That's expected to bring down the current government of Prime Minister Bayrou. That's pretty much baked into the cake at this point. It's priced in. So I don't think there's going to be a huge amount of reaction. But if it becomes very, very clear that either, the sort of the leftists or the National Front, the right-wing parties, the conservative parties, they really don't want to support any kind of fiscal reforms. We could actually see a follow-on effect with the French bonds, the OATs here. And as you see, they've had a nice little rally and a bounce off this level. We spoke about that a little bit this week. If it's the case that there does look like some political paralysis and a lack of fiscal discipline and zero interest in kind of reining in the budget, I think it's absolutely possible that the OATs here could actually turn south again and go down a little bit. And that could put a bit of pressure in turn on the euro is my point. Equities is an interesting one. If we look at volatility, you can see the volatility is pretty low. You can see we're only at a 15% handle here in the VIX, so less than 1% daily move divided by 16. So, expecting maybe like a 90 basis point move or so. So relatively low. In terms of, as I said, we had Broadcom last night. What could the equities do? I mean, this is going to be an interesting one. I think what the equity market probably wants today is a number which justifies the Fed cutting, but not weak enough or not strong enough, not an extreme number. So let's say it's a very strong number that could put in doubts the fact that the Fed might need to cut, two or three times this year, and then going into 2026 could also put worries about inflation. On the other hand, a very, very weak number, a negative number, or I don't know, 10 or 20 or 30,000 payroll number on the headline, that could really signify that the labor market is deteriorating rapidly, which could presage, again, a very sort of strong slowdown in the real economy, which maybe is not great for stocks. So interesting to see here. I think what stocks wants is a number which is, on the softish side. So the expectations, as we saw, is 75,000. I think probably the stock market wants, 60,000, 65, 55, 70, something like that, Anything in that range, I think, is got to be a positive for the stock market because that will not derail Fed cuts, but it also indicates that the labor market and the real economy is chugging along, motoring along at a reasonable pace, and that's probably what the equity market wants. As I say, I think an extreme number could put the equities under a little bit of pressure. Right. Okay. So other things to talk about, guys, is just want to quickly have a look at the at oil here. We have the OPEC Plus meeting over the weekend on Sunday, I think technically. And again, there is a lot of rumors swirling around that they will increase their production, as I've been saying. There's also some other people saying that it's not a done deal. So could be quite an interesting open on Sunday evening at 6 p.m. Because obviously if they increase their production, and let's say, for example, we get a weak number today, signaling that maybe the US economy is starting to sort of slow down a little bit. Oil, I believe, will not like that at all. And at a minimum, I think we can get down to this level down here, 61.5, and maybe even break that and push down into the 60s, something like that. On the other hand, if the numbers are, solid today in the US and also in Canada, which I'll talk about in a second, and OPEC Plus decides not to not to hike their production, to increase their production, we could get a bit of a relief rally, and we may end up testing up to this 100-day EMA. That's going to be an interesting one to be looking at over the weekend. As I said, let's have a quick look at Canada because we also have the Canadian numbers today. So first of all, let's just look and see here. Let me just bring this up. Sorry, guys, I'm just going to have to put in a few things. So echo Canada. And so let's first of all see what's expected here. So we're seeing that the net change is only positive 5,000. Remember last time it was a pretty horrible number. Last month prior was minus 40,000. So this is a pretty weak number still. The Canadian economy does seem to be weakening on the back of the tariff issues with the United States. Unemployment rate is expected to tick up into 7, so that's well below above the US. Remember the US 4.2, maybe going up to 4.3. In Europe, it looks like in the 5s to 6s. So Canada's employment situation is not great. The employment rate is by consensus meant to go up to 7, which is not good. What's always very important in Canada, of course, is look at the split between full-time and part-time, not just the headline number. And if we just look at the economist estimates here, let's just see what the range of readings is. You can see that the average, about 5,000, 4,500, but there is a high of plus 35 and a low of 45,000. So again, the standard deviation, even for Canada here, is 20,000. So, one standard deviation would be, plus 25,000. On the downside, that would be minus, minus 15,000. So quite a big dispersion here between what economists, surveyed economists believe. Although, to be honest, it's only 11, 12, 13 economists here. So let's not overread that. But nonetheless, keep that in mind, quite a weak number. Now, in terms of the Bank of Canada, the jury is still out as to whether they will be cutting again anytime soon. So if we actually just go in, let's just see what's actually priced at the moment. Let me bring this up for Canada. You can see that for their meeting on the 17th of September. Hold on, is that the same day as the Fed? That's the same day as the Fed. Okay, so Canada's in the morning. The Bank of Canada's in the morning and the Fed in the afternoon. That's an interesting one. Okay, so no doubt they're coordinating behind the scenes. So as you can see here for the next BOC meeting, a 62% chance. So a little bit, just over half expecting a cut out of a 25 basis point cut, 15 basis points. So almost at a halfway point. And so the labor data today could be quite important in the sense that if the labor data comes in, a lot better than expected, let's say unemployment rate rather than going up to 7% comes in at, 6.7, 6.8, and let's say instead of only 5,000 jobs, let's say it comes in at plus 25, plus 30,000, and most of those are full-time jobs. That could cause the market just to bring that down to like a 50% chance of a cut. On the other hand, if the numbers do come in badly today for Canada employment, for sure this number could head up towards maybe 20 basis points of cuts, which could push us up to maybe, I don't know, let's say for about 3/4, like 75% chance of a cut. So quite an important one today for the Canadian dollar. Of course, the Canadian dollar will obviously, a lot of the the push for that's not going to just be on the Canadian numbers, but also what happens over the border in the United States. So, the perfect thing for the Canadian dollar obviously would be a strong number and then a weak number in the US, or concurrently, it could be the opposite. On the other hand, if those numbers are mixed, it might be a bit tricky to be trading the Canadian dollar directly. Okay, all right. I think I'll leave it there. Let's all get organized. So I hope that was useful. And just was one other thing I forgot to show. Just I pulled this just from some research this morning, just from JP Morgan Trading Desk. Apparently, just their views of where the stocks might go, the SPX. Again, their base case, this 40% base case, is basically what's consensus. Is about 75,000, between 65 and 85,000. They're saying that's going to be just a sweet spot for the SPX, up 50 to 100 basis points. Again, anything sort of soft, uh, you know, they still think that 40 to 65 will be a little on the soft side, could still have a small gain here. But of course, below 40,000, which they think is low probability, over 5%, you could see the SPX losing 25 to 75 basis points. And again, what for them is going to be the worst scenario for the stocks is actually, again, only 5% chances above 110,000. So keep in mind the standard deviation was 20,000. So above 110,000 would be well above, let's say, two standard deviations. Um, uh, Out of this, it would gain 1% to lose 1.5%. So that's what a lot of people are saying. Uh, that there could be an initial pop, and then that could be sold just on the realization that the Fed might not be cutting as much. So interesting if it does go high. A lot of market commentators are expecting some initial pop, and then a sort of a sell-off. So that's kind of interesting here. They're saying it gains 1% to then lose 1.5%, and a similar kind of situation on a 85 to 110,000. They're saying it would gain maybe half a percent, and then would actually sort of come down a little bit. So that's interesting, this notion that a lot of market commentators are saying a good number is going to initially rally, and then will be faded as the realization sinks in that that will sort of take away the possibility of the Fed cutting so much. And obviously, a way to look at that if you're day trading would be to keep an eye on the SOFR contracts for, let's say, September and December, just see how they're going, and also the 2-year yield will give you a bit of a clue on that one. Okay, guys, have a great day, have a great weekend, and we'll keep this going next week. Have a great day. Thank you.